question, but I think it's important for our audience, so let's do it. I hear 2018 is set to be the biggest year ever in Treasury bonds reaching maturity. At the same time, the Fed is making noise and wanting to finally reduce the size of its balance sheet as we approach the 10-year anniversary of the credit crisis. If true, sounds like 2018 could be a great opportunity to let some of this debt roll off. What do you think the Fed will do, or what should they do?
Well, first, there's an investment implication in the question, Angelo, and that is that we're facing kind of a maturity cliff of treasuries and a refinancing cliff, and perhaps the Fed stepping back will create some sort of deficit in demand for securities with the consequence of rising yields. I would say that you never know the contrary trends that might emerge. People for years were saying that as soon as the Chinese begin to sell, and before that, as soon as the Japanese began to sell their hoard of treasuries, that yields would rise because who would want to buy them in the face of the liquidation of these great Asian savers? Well, the Chinese have been selling. Foreign central banks have been selling treasuries, and yields have long and certainly have not risen, but rather have remained stable, or actually recently gone down, because there is a compensating demand elsewhere. So I would say to the implicit suggestion of a bear market in bonds owing to these trends, I would say that is not a source of worry. That might be a bear market for other reasons, we think there's likely to be, but not for that reason. Now, what should the Fed do? The Fed, I'm going to answer this question in a very roundabout way, Angelo, but you told us we have 3 hours in this call, so I'm just going to take my time. Yeah. The Fed has a $4.5 trillion balance sheet, and if you look at the capital beneath that balance sheet, you need a magnifying glass. The Fed's assets in relation to its equity are 111.7 times. It is leveraged 111.7 to 1. Now, that is the equivalent of like 6 brothers in the Leaning Tower of Pisa. The Fed, to look at it, looks like an exhibit from a Delaware bankruptcy court proceeding. The Fed is immensely leveraged. It generates a reciprocally, implausibly titanic return on its capital and surplus. I mean, this institution is a scandal as a bank. If you were to look at it as a security analyst, you would say, what is going on with our national finances? So the Fed has this gargantuan balance sheet. What should it do? Well, it should not have accumulated these securities in the first place. It accumulated these securities because, said Chairman Bernanke, by buying bonds, it would increase the value of assets. People holding these assets would be stimulated to purchase more. We would be off to the races and growth, blah, blah, blah. Well, that didn't come to pass. So the Fed is now stuck with these securities. I don't know what it's going to do. I think we ought to try, as a nation, to get back to a state of monetary normalcy. And that, to me, would entail, among other things, a rethink of the entire method and doctrine of central banking as it's practiced. Certainly, we ought to think about and to implement policies that give us actual market interest rates rather than these hothouse interest rates that the government sanctioned and manipulated. So whatever the Fed's going to do, boy, Henry Kissinger once said of the Balkans that whatever you do is going to be wrong, including nothing. And my experience with the Fed is that whatever it does is going to be wrong, including nothing. So right now they're talking about scaling back on the balance sheet and implementing 2 or 3 more rate rises this year. Well, maybe that's a good idea. I think in the abstract, it is a wonderful idea. We should have a structure of interest rates that is more or less normal. Normal is a lovely state of being. But we have had 8 years or so, whatever it's been, of artificially low rates, of stunted miniature interest rates that themselves induced trends in the economy that make the economy rather more fragile and less prone to stimulus. So the Fed, in seeking to save us from deflation, has actually itself introduced deflationary kind of a deflationary undertow into our affairs. And you can see it in a lot of operating businesses. And I dare say they're very capable business people who have built the fortunes that have made them eligible for membership in your organization. They see this. They certainly see it. And for example, in the automotive business now, you see used car prices breaking down because of the plethora of cars coming off the lease, owing in good part to the interest rates that make these leases lucrative. You see it, this inflationary undertone in the retail food business. Margins are very, very low, too much stuff, too much competition, not enough bankruptcy. Not enough bankruptcy. It's one of the paradoxes of a capitalist regime. A proper capitalist regime is dynamism, right? You need new entrants and you need exits. And one of the really interesting sightings in Japan last year was about a single publicly traded company filed for bankruptcy. Not one. There were like 4,000. So is that a sign of health or is it a sign of something else? To me, it's a sign of deep malfunction. When nobody goes broke, it means it's a state of stasis. What you want is a lot of movement.